Have you ever tried to read something about investing, but you felt like the whole thing was in another language? You were like, okay, I think I know where the stock is. Maybe I got you. In this video, we're going to break down investing terms that you might have heard, and I'm going to put it in a way that it actually makes sense. So you don't need a finance degree to know it. It's no mathematicians required because understanding this, it shouldn't be something that you have to decode. It shouldn't feel like it's a foreign language. So we're going to break it down. Let's talk about it. Hey goalies, welcome back to the channel where we keep it real about all things money, confidence, and financial success. If this is your first time here, I'm Mia, the Coin's Confidant, and I'll help you build confidence and clarity to crush your money goals. Now, I need a favor. I need you to hit that like and subscribe button. Drop down in the comment if there are some investing terms that I did not cover, but you want the definition to, because I would love to make a part 2. All right. So let's get into it. The first thing that I want to let you know that if you've ever listened to any type of investing content and felt lost, felt disheveled, or you've listened to some supposed content that's for beginning investors and you felt like, okay, I still don't know what's going on. They're using so much jargon and all these terms you don't know and you don't understand, and they're talking as if you should already understand. So I created a series, and it's an investment series to help you go from clueless to confident about your investing journey, because that's the whole purpose. If I'm not confident in an action, I'm less likely to take it. Okay. So as you go through the different videos of this series, you'll have this video to go back to look and find out the different terms if you have a term that you don't understand. Now, I do plan to define the terms in the different videos, but you won't have the visual that you will have today. So today, baby, we about to get into it. So let's go. We're going to start off from the basics, okay? We're going to start off with a stock. A stock is simply a small piece of a company. So if you own one stock, you own one piece of that business. So the more stocks you own in one business, the more ownership you have in that business, the more decisions you can make. So for example, whenever you hear somebody have 56% ownership or 65% ownership, that means they have enough ownership that they actually call some shots of what goes on in that company, or they have the ability to, because they have a ownership that supersedes anybody else. Because if I own more than half, I have a higher percentage than anybody else can get, right? Okay, so if you remember, or this is not your first video with me, typically, well, if this is your first video, I like to use trees. When I break down stocks, bonds, and different things like that, I use tree. So throughout this whole video today, we're going to use trees as an example so you can wrap your head around investing. Now, not too much on my artwork, okay? I'm here to help you and teach you about money. Remember? So we're going to be nice to the nice lady that's breaking down stocks, even though her artwork is not the best. I teach money, not art. Okay? All right. So let's just say, for example, if you have an entire forest, if I purchase in a stock, that means I'm purchasing one tree. So that's my one tree. This is the grass at the bottom. So we're going to consider this one tree, one stock. Okay? And again, as you go through this video, if you have questions, drop your questions down in the comments, because I want to know them, and it also will help me when I'm making future videos to make sure that people can understand. Okay? So this tree represents you owning one level of ownership in this forest. You only own one tree, so you don't have decisions to make about what happens with the forest. Like, say somebody wants to chop it all down and build a new housing development, you don't have a lot of ownership to say yay or nay. Yes, you get a vote because you own one share, but you can't overpower someone who might have 65% of the vote, like I talked about before. Okay? Now, we're going to get into mutual funds, ETFs, and index funds. An ETF is an exchange traded fund. And now we're going to use the same metaphor. We still in the forest, y'all. We still out here in the woods. So if a stock was one tree, think of a mutual fund as a group of trees. So this is your mutual fund. You're going to have a group of trees. It's different type of trees though, right? These not all going to be the same. Okay? The difference between this mutual fund and the stock is, see, you got a variety. Like this one, we're going to say that's a different type of tree. This is going to be a different type of tree. You see what I'm saying? It's a different variety. And what's even better is, let's just say these are trees that was planted for you by somebody else who curated these trees for you. So this person picked out the best trees that should grow well and that will do well and have a good history, and they did their research to give you the best crops you can get from these trees. And they're going to grow strong and they're going to bear a lot of fruit for you. So that person who curated these trees is going to charge you. They're not curating these trees and spending their time researching and picking out these trees for nothing. They want their money, so they will be compensated. So mutual funds come with a lot of fees. They have higher fees because think about it. You have somebody handpicking it. So this is a stock. Okay? Does that make sense? Okay, we're moving on. Now we got index funds. So an index fund, gotta draw my graphs, gonna have the same thing. Index fund, a whole bunch of trees. We got see, that's a big tree. Different trees. Okay? Now that's basically an index fund. So think of the index fund as wild. So you see, these are not as carefully curated by a person. You know what I mean? So they're wild, but they're very steady. So it's a group of trees, and the goal of these trees is to mirror the whole forest. So they're still going to have fees, but their fees are not going to be as high because nobody didn't hand plant these trees for you. Okay? Okay. Now, ETF, the exchange traded fund. This is the fund. So it's a fund. And what did we learn about funds so far? Funds are a group of stocks and bonds as opposed to a stock that's just one singular stock. So this is going to be ETF. So again, it's going to be a different type of tree. It's going to be a group of different ones. Okay? The difference in this is I want you to think of these as a group of trees that were already put together, packaged. They come, you can go get 15 different types of these same exact investments. They're not curated. They're not here to reflect the whole forest. It's kind of like if you go to Home Depot and they got the nursery and they got the group of plants already put together and packed for you and you just got to grab and go. That's what ETFs are. So ETFs have the lowest amount of fees because it has the lowest amount of maintenance that's happening to make that fund happen. Okay? So it gives you quick access, but the benefit in mutual funds, index funds, and ETFs is your money is diversified. And basically diversified means that you're not putting all your eggs in one basket. So if a tornado come through and hit this forest, think about it. If a tornado come through and hit this forest, if it knocked down this one tree and you put all your money in this one type of tree, and it's this one section that just got these one trees there, and all your money was in them trees, guess what? Your money gone. But if you'll put your money in a mixture of trees, some of these trees are going to be strong, some of them might be weak. There are different levels of trees. You have a better opportunity for your money to withstand that volatility. And we'll define what volatility means, but it basically just means the chances that your investments will grow or decline. Okay? It's the chance that it will happen. And it's the fact that every day it might go up, it might go down. How much it does that is kind of like the volatility. And so typically when you're picking a stock or you're picking an investment, you want to be wary of that. And when you see everybody like, oh my God, the stock market is going down, people are scared, people are uncertain. So that's causing the stock market not to thrive in that moment. That means it's a sale. So if you have stocks that you already purchased and they've dropped tremendously in price, you have no intentions on getting it, you might want to look into maybe if you could purchase some more, do some research, figure out what's the best option. Should you purchase some more? Should you not purchase some more? But when they are down, that's a great time to buy if that's something that you're interested in doing. I'm only here to give you educational information. This is not investment advice. I am not a financial advisor, and I'm not here to give you any financial advice. I am here to educate you so you feel more comfortable in the process. So as we talk about mutual funds, index funds, and ETFs, they are filled with stocks and bonds. So we already talked about what a stock was, right? A bond is basically like if you loan your money to a company or even the government. In return, they're going to pay you back your money and you're going to get interest, okay? So it's pretty much like when you buy a bond, it's like you being a bank to someone else. And in return, they're going to pay you your money back with interest. So bonds are very secure, very safe, but they have a very slow growth rate compared to stocks. Okay, so that's something you want to think about. Now, dividends. So consider a dividend like a thank you check. So different companies, not all, I want you to know that not all companies do this, but some companies will pay you a part of their profit just because you own their stock. Yes, I said it, I'll say it again. Some companies will pay you money just because you owe some of their stock. It's called a dividend. And just to give you an example, so imagine you got this tree. Let's just say this tree is an orange tree, because that's the only thing that could possibly look like is oranges. Maybe some peaches. Could be some peaches. Oranges or peaches, one of the two. Okay, let's go. And so let's just say you have bared fruit. You did the work, you bought this tree, the tree is planted, then it bear fruit. Consider that fruit your dividends. Because you held down in that tree and you own that tree, whatever fruit it bears, it gives you some of that fruit. Like a thank you, like a reward. Now you have two options. When that fruit starts falling off that tree, you can either reinvest that fruit and plant it so it can grow more trees, or you can eat that fruit right now and cash out and take your dividend. Now, reinvesting it is called drip. And what's going to happen is you're going to reinvest it and you'll get a partial tree. You won't get another full tree. Well, it depends on the cost of your first tree, but that's another concept. But you will get a portion. But as you continue to get more dividends and go, that money is going to compound on each other. Okay, so I think that's a great deal. That's a dividend. I like dividends. Now, let's talk compound interest. Compound interest is big. Compound interest is huge. And compound interest is the method to the madness, baby. Compound interest is what makes investing so beautiful. I'm cleaning off my thing so we can get to the next conversation. So, compound interest is basically when you earn interest on your interest that you already have. So let's just say you put money in the bank. When you put money in the bank, they tell you that you're going to earn interest, right? Okay, you put money in the bank, they tell you you're going to earn interest. Well, when you earn interest, they calculate the total balance that you have in that bank account. They don't say like, oh well, she put in $2, we put in $5, so we only gonna give her interest on the $2 that she put in and deduct whatever interest we've given her thus far. No, they're gonna add your money, they're gonna add their interest, and they're gonna put more interest on top of the entire balance, which means that the interest that they gave you before is gonna compound because you didn't put that money in there. Think of it like a snowball rolling downhill. So compound interest is going to be the snow that starts to stick to it every time it rolls. And as it adds up and becomes an even bigger snowball, that's the concept you want to think about when it comes to dividends. Okay. I mean, that's the concept you want to think of when it comes to compound interest. All right. Volatility. Now, we talked about this. I just talked about this. I told you I was going to come back and define it. This just basically means that prices are going to go up and they're going to go down a lot. So the example is like you see the signs for the gas prices. You see sometimes it may go up depending on what time of the day. It might go up, it might go down. That's the same thing that's happening with the different stocks and bonds and mutual funds. They all have a price that you pay to purchase them. And so that price could go up, that price could go down. The market, it's like somebody's mood on a Monday. It might fluctuate, don't take every dip personally. It's nothing personal. It's nothing against you. And it could take a dip in the middle of the day and then by the end of the day be back up. So don't attach your emotions to it to the point where every single dip it takes, you're like, oh my goodness. Like, don't do that. Okay. Now, risk tolerance. Risk tolerance is basically like your ability to handle the ups and downs. Okay? It's going to be ups and downs. There's going to be, what's the word? Volatility. So you have to be able to handle the ups and downs without panicking. So let's just say if you can't sleep because your investments dropped by 5% and you like, oh my goodness, I can't sleep, I'm up at night, I'm frustrated, then you might want to change how you are exposed to risk. You might want to pick less risky stocks so that you can get rest because peace of mind is important. Like, yes, higher risk, higher the reward, but stress is a huge risk. And if you are stressed out while you are worried about your money falling to the point where you can't sleep, I think that's a higher risk that you might not be willing to take. And it might cause it to be like unhealthy. Stress is serious. The next term is time horizon. And so time horizon is basically how long do you plan to keep your money invested? So if you need this money in 6 months, your time horizon is going to be pretty short. But if you don't need it for about 20 years, like when you retire, then you got time to ride the waves. And by riding the waves, I mean you have time to ride as the market goes up and the market goes down. You have the ability to ride those waves because you have a while before you will be touching that money. Now, our next concept is time value of money. And this is basically the principle that a dollar today is worth more than a dollar tomorrow. And because the reason why is because a dollar the next day is not going to be able to buy you the same thing. Think about it as when you were little and you used to get out of school and you might go to the candy store. And I don't know where, everybody watching is located, but from where I'm from in Chicago, you could go to like the candy store or you could go to like the candy lady and you could go buy things and you could pick what you want to get. And a dollar would take you pretty far, baby. A dollar would take you some places. You could get some penny cookies, you could get some juices, some chips, a pickle. You could get a lot of stuff with a dollar. What can you get with a dollar now? So let's just say $100 now in the market, it could turn into $200 later, right? That same $100 5 years from now, it don't have the same power. So you know how like you're online and you see those questions and they're like, well, would you want to take 30 million dollars right now, or would you rather take get $30,000 a week for life? Give me 30 million right now because I can do more with 30 million right now than I'm gonna be able to do with them thousands in the future because as time goes on, it's going to be worth less unless it's invested somewhere and grown somewhere. I can get that 30 million right now and invest it, strategize, of course, meet with a professional so that I can make my next move my best move. And then I can really make it work as opposed to getting it later and it's not worth as much. I've just lost some of my money without even doing anything. You already have to pay so much out to taxes and things like that. So now we're going to talk about Roth IRAs and traditional IRAs. And so these are basically retirement accounts. An IRA is an individual retirement account. This basically means this is an account that you set up yourself as an individual. You have other retirement accounts that are employer sponsored retirement accounts. An IRA means you set it up. Now, there are different types of IRAs. And so there are different types of 401ks. You have Roth and traditional. And these are important in considering taxes. That's the biggest point about these that you need to know. With a Roth IRA, you're going to pay the taxes now, and then your money is going to grow tax free. So when you go to deduct your money in retirement, you won't get taxed for it. Kind of nice. The thing about it is you want to think of it like if you plant a seed and then you don't have to pay taxes on it when it becomes a tree. It's not like, oh, it's a tree where you got to pay us 20% of whatever fruit it bears. That tree is yours. You pay taxes on the money. When you bought that seed, you paid your sales tax, and you don't have to do it anymore. Okay? All right. Now, a traditional IRA is you get the tax break now, but you pay the taxes later. Okay? So you basically get a tax break now. And what it means by tax break now is it's when the money is applied. And that means that you can, say for example, so I got to write this down because this is going to be easier to do. So we're going to write Roth and we're going to write traditional. So let's just say we're getting paid $100. This your paycheck, okay? This is your paycheck. Now we got taxes. Taxes is going to be $10 because I'm a generous woman. So taxes, $10. The difference between a Roth IRA and a traditional IRA or a Roth 401k and a traditional 401k is when the taxes are applied. And I want to show you why that makes a difference. This is very critical for high earners, us high achievers who are out here, you're making more money and you need to think more strategically. Maybe your children are becoming grown, you no longer have them as dependents. You need to get a little bit more strategic with your tax strategies. I definitely recommend a tax strategist who can actually really help you strategize how you pay taxes, how you do things, okay? If you need a referral, I can absolutely refer you. Drop it down in the comments. I'll refer you. So with a Roth IRA, you're going to pay the $100. You're going to take the taxes out, which you're going to have $90. Now you're going to go put your money in your Roth. Okay? Which means that you got taxed on that full $100. Then you took 10 and you got 90. Now over here for traditional, you put the 45 up here. So you getting taxed on, what's that, 55? So you're only going to get taxed on $55, okay? As opposed to getting taxed, I know I just did math, but you get the hint. You're getting taxed on $55 as opposed to getting taxed on the whole $100. But when you go to withdraw the money from retirement, for your Roth, you already paid your taxes. For your traditional, you didn't pay your taxes. Instead, you lowered the amount of income that will be calculated as money that needs to be taxed. So hopefully you grab that and you understand. If you have more questions about it, let me know. But that's the biggest difference. When you get paid, it's when you are taxed. Um, and I will say, don't come in here and get technical in my comments. I was just trying to break down the strategy for those to help you understand when you are taxed based on what type of account you have. Now, moving forward, we wrapping it up. We wrapping it up. Brokerage account. A brokerage account is basically an investment account that will allow you to buy and sell investments. So the stocks, the bonds, the mutual funds, the index funds, and ETFs that we talked about today. That's one of the places that you can buy them. And typically, in a brokerage account, is managed by a brokerage firm. You could also do this inside your retirement account. You can do this inside an IRA. You can do this inside your employer sponsored plan, but typically your employer sponsored plan is going to list certain amounts of stocks and bonds or certain funds that you can invest in. It's not going to be the same as you being open to invest in everything that's available. So FYI. But typically your employer will offer you a match, which basically means they will match the money that you put in there. So they'll have their different guidelines that you have to find out. But let's just say it's a $5 match. So you put in five, they put in five. It's like playing double dutch. It's a competition. That's wonderful. That's money that they're putting in that's getting calculated in compounded interest for you. So it's a win-win if you ask me. The thing to note though is the vesting schedule at your employer. Now, a vesting schedule, basically with your job, sometimes they'll match your 401k, but the money doesn't fully belong to you right away. That's where vesting comes in. Your job will say, oh, well, you get 100% of this match, but you have to stay for 3 years. That's their vesting schedule, that you have to stay for 3 years. Some companies might have 5 years. So they might have, a company might have 1, 2, 3, 4, 5. At 5 years, you get 100%. At 4 years, you get 75%. At 3 years, you get 50%. You get what I'm going? At 2 years, you get 25%. At 10%. And this is of their money. You're always going to be able to get back the money that you put in, but you want their money too. You work there, you went to work, and believe it or not, that money is a part of your compensation package when they quoted you that offer in the beginning. So, if at all you want to find out the vesting schedule, because let's just say you're looking for a new job and you find out the vesting schedule is 3 years and you got 2.5 years, don't you think it'll be worth it to keep that extra and get that extra money? Now, if it's something that's bothering your mental health and you, again, you can't help it, you got to do what you got to do. But knowing that information might help you be more strategic when you look to leave a job or transition into another role. Be strategic with collecting as much money as you can in your account, and then you just roll it over to somewhere else. Now, ticker symbol. Every stock has a nickname. And this nickname is basically how you know when you want to go buy that stock, sell that stock, look up that stock, research that stock. You basically would look up its ticker symbol, and that's how you would find the information for it. So, for an example, Nike, NKE is the ticker symbol. So, for Nike, if you want to do anything with Nike, you would have to look up NKE. My Apple lovers, if you want to look up Apple, it is AAPL. That's like its nickname. You type that in. That's the way that you're going to research the stock. You want a great place to research stocks? Fool.com. Yes, you heard me correctly. FOOL.com. It's the Motley Fool, great website to research. Yahoo Finance, great website to research. I'll be making a video about researching, but obviously that's coming later in the series. Now, market hours. Market hours is basically the hours that the stock market is open. The stock market is not open 24 hours. It is open Monday through Friday from 9:30 a.m. to 4 p.m. Eastern Standard Time. And that's except holidays, okay? That's when trades happen in real time. Anytime you are trading outside of those hours, it's considered after hours, or if it's earlier in the morning, then it's considered pre-market, which is less stable. And it's less stable because if you buy it at that time, market doesn't open back up till 9 o'clock the next morning. Okay, so this is things you got to think about. You might hear different terms like options, futures, day trading. I want to be and make you aware those are not beginner investing friendly. Honestly, everybody is not made for trading options, futures. It's not. You want to definitely get the basics before you go jump out there because you can lose a lot of money. We're going to talk about these really quickly just so you can have an idea what they are. So basically, options is basically when like you're betting on when a stock will go at a certain rate by a certain date. You see what I'm saying? That takes somebody who has skill, that takes somebody who's kind of learned the market, knows about it. Because how do you predict what a stock is going to go by? So you basically betting where a stock will go. It's going to sell at $200 by this day. That's some skill. That's some skill. You can definitely be risky and try it. But I believe it takes a skill to do that, and I think you should work on the financials. The foundation first. Futures is basically when you are agreeing to buy or sell something, but at a future price. So at when it gets to $20, then I agree I'll sell, or I'll buy it when it gets to this. You're basically agreeing to do that. Next, you have day trading. So day trading is when you always hearing buy low, sell high. Those people who like every single day they're trading. It's basically you're buying and selling, and you're doing all of this within the same day. And you're basically riding short-term waves. So again, very risky. You're moving very fast, and it's not a good place to start because at this point you don't know much about what's going on to make the decision of which ones you should sell, which ones you should buy, and know when to jump and move. That's why I don't teach about any of those two, because I teach beginner investing for those looking to get into investing. I teach beginner investing for those who have been scared or fearful about investing in the past. Whew, that was a lot. I know that was a lot. But listen, this is not meant for you to memorize. This is meant as a resource for you to listen to over and over and over again as many times as you want to. It's just here so you can recognize it. When you hear it again, you're not going to be as lost. It's not going to sound as foreign. You're going to be like, that crazy no drawing Mia told me about this. And you're going to be thankful for me. Mm-hmm. Thank me later. Okay? Here's the thing though. You do not have to be perfect at this. You just have to be consistent. And I wish I would be able to tell you that you're never, ever, ever going to lose any money and it's going to be wonderful. It's going to be fabulous and you won't have any problems. But that would be a lie. And I'm not here to lie to you. We keep it real. Remember, like I told you in the beginning of this video, it's a reality that it might. But that's why you build a calculated, strategic way and method that you decide what you are doing. Another term, dollar cost averaging. Dollar cost averaging is basically you set a plan. I'm gonna buy this amount of stocks, and I'm gonna buy them over and over and over and over again. It's called dollar cost averaging because you're not so much focused on, oh, the price is up or the price is down, let me buy or let me sit. Like, you're not focused on that. You're just focused on consistently buying. So you're gonna get some high, you're gonna get some low, but your consistency is what's gonna help you make money over time because they're all gonna grow, you know? So it's important to know too that maybe nobody around you has invested. You know, maybe nobody around you has had conversations about investing, but you're breaking that cycle. Mhm. You're already ahead of the game just by learning this, and especially if you made it to this point in the video. If you have children, feel free, watch it with them. Talk about what I talk about. Make jokes about me. Laugh at me. I don't really care. As long as it's you learning the information, retaining the information, as you continue to listen to it, you will retain the information. As you teach your children and you teach them about stocks and they learn about stocks, you'll learn too. You learn and retain way more of the information that you teach to others. So you do what you got to do. I'm here for it. Okay. Now, in the next video, I'm going to show you how to start investing with what you have, even if you feel behind. Even if you feel like, oh my God, I should have been here by now. I should have had my mega million portfolio. That is fine. That is fine. We're going to teach you how to get started. Okay. So until next time, goalies, keep showing up for yourself and keep crushing your money goals.